Hello, everyone, and welcome to episode 43 of JustDario Cigar Time. What an incredible week we just had in the markets, and the one about to start looks poised to be another barn burner. Today, I want to dive deep into two major themes. First, I share my detailed thoughts on the AI and semiconductor sector. I've read a lot of misleading, if not outright wrong, interpretations of the latest news concerning Oracle, OpenAI, NVIDIA, and others. Second, I'll explain on the ramification of a highly likely Federal Reserve rate cut this week, a move I believe is completely inappropriate for the current economic climate. Let's get into it. What we are witnessing in AI right now is, I believe, unprecedented in market history. We have a single company, OpenAI, whose CEO routinely throws out numbers in the hundreds of billions, even trillions of dollars, and these figures are met with little skepticism. Why? Because OpenAI has masterfully convinced a vast number of analysts and the public that its operations are not just huge, but critical to our economic future. The reality, however, is starkly different. As I outlined in my recent article, OpenAI, little cash but plenty of promises, this is a company burning a catastrophic amount of cash while failing to generate meaningful revenue to justify it. Remember, OpenAI is private. Its financial data isn't public. What leaks into the press is often a carefully orchestrated PR move from the company itself. For context, recent reports suggest OpenAI has reached around $12 billion in annualized revenues. Sounds impressive, right? But its cash burn is projected to hit $8 billion this year alone. Through 2029, total losses could reach a staggering $115 billion. And that's before we consider their new mind-boggling $300 billion agreement with Oracle. This underscores a massive discrepancy between hype and financial sustainability. But their last PR stunt was a bridge too far. The announcement of a $300 billion compute deal with Oracle finally made people ask questions. How can OpenAI commit to such an astronomical sum? How can Oracle accept it without cash advances or guarantees, especially when Oracle itself is experiencing negative free cash flow and lacks the obvious resources to build the required infrastructure? The electricity requirements alone are utterly unrealistic. What we saw last week was a masterclass in behavioral finance. Initially, everyone cheered. Oracle's stock soared 40% in a single day on the news of their massive remaining performance obligations, a move straight out of the dot-com bubble playbook, but on a much larger scale. Then, the Wall Street Journal published an exclusive revealing that this entire jump came from a single OpenAI contract. Then questions began, but even when people asked the right questions, their answers were often completely wrong. I saw one post on X that perfectly captured the misunderstanding. This person argued, how can Oracle afford to build the infrastructure? Simple. Sign the contract, announce it, the stock goes up $300 billion in market cap, and there is your money. This reasoning is dangerously flawed. It highlights a fundamental confusion between market valuation and real liquid cash. A stock's market cap is calculated based on the price of its last trade, no matter how small. Oracle's market cap did jump hundreds of billions, but that does not mean hundreds of billions in cash suddenly materialized in Oracle's bank account. That wealth is largely theoretical and exists on paper. The more realistic scenario, Oracle already has over $100 billion in debt, must now go to banks and lenders, hat in hand, to borrow the real money needed to build those data centers. Any sane lender will then ask, okay, but does OpenAI actually have the money to pay you? And the answer for anyone who can run a simple calculator is a resounding no. Analysis from sources like The Information suggests OpenAI losses hit about $5 billion in 2024, with cash burn potentially reaching $17 billion next year. So this deal is already a house of cards. This leads us to the crucial question everyone should be asking. How much real cash is behind these bloated valuation and promises? The answer is very little. Let's look at OpenAI's numbers. They boast 700 million weekly active users. Sounds massive, but how many are paying subscribers? The number is far lower, almost 20 million according to the company, with about 3 million being business subscribers. This claim is frankly ridiculous. Let's do the math. In the entire G7, there are roughly 1.35 million corporations with more than 30 employees. So for OpenAI to claim 3 million corporate subscribers suggests that every medium and large corporation on Earth, and then some smaller ones, is using their service. This is simply not credible. When you factor in Microsoft's 20% revenue share and other undisclosed costs, the real revenue figure is likely much, much lower. What's really going on? This is a Ponzi scheme. Operators like OpenAI are trying to suck as much capital out of the system as possible to keep the illusion alive. But remember, cash is king. Even in an era of abundant liquidity, it is not unlimited. There is a critical difference between real cash, liquidity, and valuation. A company like NVIDIA being worth $4 trillion does not mean it has $4 trillion in cash. If just 5% of shareholders decide to sell, that valuation will crumble. We have overblown valuations balanced on a razor's edge of liquidity. This is the most dangerous misunderstanding in the market today. Now, let's turn to the Federal Reserve. This week, we are almost certain to see a rate cut. But let's be clear, this is the wrong move. Monetary conditions are already loose, reminiscent of the beginning of the 2022 easing cycle. Cutting rates now is completely counterintuitive. Consider the recent rhetoric. Even Treasury Secretary Bessent recently stated on X that the Federal Reserve is among the foremost drivers of inequality in America. By failing to deliver on its inflation mandate, the Fed allowed class and generational disparities to grow worse, expanding the divide between asset owners and lower-income Americans. The Fed must regain its independence and stop serving the wealthy at expense of everyone else. So effectively, he's accusing the Fed of expanding the divide between asset owners and low-income Americans. If that's what the Treasury Secretary believes, why is the administration pushing for rate cuts that will overwhelmingly benefit asset owners? The truth is, this rate cut serves two cynical purposes. One, inflating the bubble. They know there is a massive bubble in AI and tech. The only way to keep it inflated and allow the administration to boast about market performance is to provide even looser monetary conditions. This is about politics, not sound economics. Two, managing debt cost. The US government has a massive deficit, projected to hit nearly $2 trillion this year. By cutting rates and having the Treasury issue more short-term bills, they are trying to reduce the government interest expense and trim the deficit. This economy is being held aloft by out-of-control government spending. Without it, we would be in a much worse place. These policies are exacerbating wealth inequality to levels beyond imagination. The average person feels inflation every day, even if the official BLS numbers underreport it. And remember, this market rally is incredibly narrow. If you remove the Magnificent Seven tech stocks, the rest of the market, particularly equal weight indexes, has been going nowhere for a while. The illusion of a roaring economy is just that, an illusion. The Fed is stretching an elastic band to its limit. It will snap sooner or later. The Fed cannot print the $2 trillion that bank analysts say are still needed to fund all these AI projects. It cannot magically create the real economic productivity to justify these valuations. This brings me to the final and most critical point. This rate cut completely ignores the radioactive assets sitting on bank balance sheets. Commercial mortgage-backed securities, CLOs, MBS, and other toxic instruments. There are trillions of dollars in bad assets in the system, worse than during the 2008 financial crisis. 25 or 50 basis point cut does nothing to solve this. The bankruptcy of the subprime lender Tricolor this week is a warning shot. The Bank of Japan already intervenes daily. The Bank of England is pumping out liquidity. The Swiss National Bank has cut rates below zero already. The Fed is cutting because it knows there is a hole in the system it has to fill. This is all a coordinated effort to delay the inevitable. I believe the AI bubble will pop, likely within the next few quarters. likely before Q2 2026. Investors will soon demand to see results, and those results aren't coming. When the music stops, the exit will be very small. The ultimate result of all this money printing and market manipulation will be a massive monetary inflation. We are replaying the 1970s. The most likely path for the US is the Japanification of its economy that led to decades of stagnant growth. And when this is perpetuated by the world's largest economy, there is a profound danger, especially as China methodically addresses its own economic issues and positions itself for global economic leadership. The social repercussions will be severe. We already see political instability in the UK and France. Don't count on this Fed rate cut to lower yields for long. If investors truly grasp what's happening, the long end of the yield curve, which the Fed doesn't control as much, will spike. If the Fed tries to enforce yield curve control, the outcome will be even worse inflation. They can fake stock market numbers, but they cannot alter the fundamental laws of economics. The economy will react to these distortions, and the reckoning will be proportional to the excess. This is a final striking reminder to prepare. The choices being made are short-term fixes that ensure a more painful long-term correction. It's a zero-sum game, and the bill is coming due. Thanks a lot for listening to my episode again today, for liking the video, for subscribing to my YouTube channel. I would like to remind you the special offer that we have at Synax till the 30th of September to access 1 month free unparalleled stock market intelligence and then lock in a 1-year subscription for just $15. Thanks a lot for supporting me on X, for following me on Instagram, and for reading and commenting my articles on JustDario.com.